Hello and welcome back to our weekly market recap. I'm with Rich.
Hello, everyone.
And I'm Knight. Let's get to it. So this past week, we saw a relatively choppy week in the market, a lot of ups and downs. Overall down 0.73%. We're still up year to date 4.17% in the market overall. But this week, we saw a lot of the continuation of storylines that we've seen throughout the past month or so. So in the one storyline that we've seen is this continued increase in the treasury rate, specifically the 10-year. We're now over 1.7%. In addition to that, we did see the Fed, and they came out and said that they were planning on holding the federal funds rate at 0% for an extended period of time, even until 2023. That hasn't changed. And then the third storyline that, again, we continue to look at is COVID and what's going on, how are cases currently going? Are we trending down? Are things opening up? What are we seeing? And specifically with spring break for a lot of institutions, we get to see what those numbers look like. And maybe not this week, but maybe in the coming couple weeks.
And that having been said, at this point, we've had approximately 30 some odd million people who have been infected with COVID in the United States, and approximately 40 million people who have received both vaccines. That combination creates a fairly large percentage of the population that's either been vaccinated or has been exposed to the virus, the coronavirus. And that is influencing where we're seeing with the economy.
Yeah, if everyone, if we're, again, 70 million out of 330 million, then, again, to get to herd immunity, we're looking at, 90%, but it's still a good portion of the way there. It would take a lot more. Now, the one assumption that you're making is, again, that the 30 million people who have been infected continue to have the antibodies, and the science isn't necessarily there to prove that long term. But if we just ignore that for the time being and look at that number, it can explain why we might see, again, some spikes in specifically the areas of the economy that have been hurt hardest: travel, leisure, hotels,
hospitality in general.
Exactly. So that basically explains, where we are in COVID right now, what we're looking for. Again, as we said, it was spring break this past week. So we do think that we might see in specific areas like Miami and, a real uptick in what the restaurants have seen. Are we going to see an uptick in cases because of it? We don't know yet. It's usually on a 2-week lag, but it is something that we'll be curious of seeing. Now,
and it's not an accident that both Florida and Texas opened up their entire economy to take advantage of the beginning of what I'll call spring break opening, and it's really almost an entire month. So that is an indication of where we are with some COVID and what we can see in the next few weeks on how the economy is doing to reflect some of this activity.
Great. Thank you, Rich. Now, for the yield curve and what we've been seeing, again, we've seen this same pattern continue where we see the short end of the yield curve. So this is that 2-year that we've been looking at. And remember, anything under 2 years, the Fed can buy. So as we've seen, relatively stable among the 2-year and under, not a lot of change. In fact, as you see, we've even seen some going down yields in the 1 month. But then we start to compare it to, again, the longer end of the yield curve. So these 5, 7, 10, 20, 30, and specifically the 10-year, because that's a really good judgment of where the economy is going to be in the future. Again, we see just even within the past month, a jump of almost 30 basis points. Now, if we look from the beginning of the year, we see a jump of almost 100%. So we've almost doubled the yield that we've been getting from the 10-year 0.93 all the way down to 1.74. So really, that's just saying, again, the it's not all necessarily bad news. If the yield is increasing because the economy is expecting to come back in full force and there's going to be, strong fundamentals leading it, that's positive. But if the yield curve is just rising because the market is expecting that the Fed is going to raise interest rates and they're just not believing everything that the Fed's saying, they're believing inflation is going to come back in a really meaningful way to where the Fed's going to have to increase rates. If that's the reason and the underlying reason why this yield curve is rising so dramatically, then that's not really good for the economy and not really good for the market, which is what we have seen. Now, Rich, as you mentioned, before, but can mention again, explain exactly why it's bad for tech and other non-dividend paying securities as to why people would then move from those into something secure like a 10-year treasury.
Exactly. And very often what we see with investments is uh, high tech is known for this, is very few of those companies actually pay dividends and people invest in them for stock appreciation. Well, the cost of holding on to an equity that's not paying any dividends is greater when you're looking at these growth stocks in general, because you're expecting the appreciation, which takes longer. And as interest rates go, it becomes more and more difficult for somebody to keep their money invested that way without getting some type of earnings, especially if treasuries, which are totally safe and are considered, quote unquote, risk-free, are rising and giving you a greater and greater rate of return. And that's why the PE ratios in general, which are the price per earnings for a stock, are greater when there are low interest rate periods and much lower price to earning ratios when interest rates are greater. We've seen this quite a bit.
The way that I like to think about it is, again, if you're guaranteed, which we don't throw that term around lightly, but if you're, guaranteed a payment from these treasuries that are very stable, why would you want, if you are guaranteed a 1.74% return, how high does that number need to get before you're willing to take risk off of the table for, oh, maybe my Tesla stock will appreciate by 10%, or maybe it will drop by 10%. I'd rather get almost 2% in, just strong yield that I know I'm going to get. Now, one of the numbers that we're really looking at is the real versus nominal rate. And once we start seeing a positive real rate of return, so what that means is if you get the rate of return minus inflation, that's your real return. If that real return, so if the 1.74% minus inflation that we've seen is positive, then it's way more likely to see people start entering into the bond market. Now, here's the interesting part. What happens when people enter the bond market? People buy more, which actually pushes the yield down. So it will be interesting to, again, see this flex flow play back and forth. But if we do get, again, some level of yield that people say, all right, now I'm willing to start entering the bond market in a dramatic way, we might see yields actually start to come down. So again, this is another storyline that we've been paying attention to. It's not new. It's something that's captured the thoughts and minds of many people. The question is, where are yields going to go from here? Now, one other piece that is really important to note is the Fed did actually just extend bank reserve requirements. So they lowered the reserve requirements during COVID, and they've actually decided to extend those. Now, why does that matter? Because the banks, with those reserve requirements, they have two options. They can either lend it out, to different people. They haven't been doing a lot of that. Instead, what they've been doing is in buying different treasuries and the longer end treasuries. Now, what does that mean? Again, more buying on the longer end means pushing the yield down. So that's another way that we can see the yield start to come down in a potentially meaningful way. There's no.
And if you look at things, during the week, we had a 10 basis point jump in the yield curve. I believe it was Thursday and Friday of this week from Wednesday. And that reflects exactly what Knight was talking about, the Federal Reserve reacting on, I believe it was Wednesday, to help keep the yield curve in the 10-year down.
Yeah, thank you, Rich. So overall for this week, a lot of storylines, a lot of continuing storylines, but unfortunately not a lot of finalizing of any of those storylines. We don't really know how all of them are going to play out, but they are pushing against one another. You have the Fed that is helping to move the market up with what they're saying, but you also have these rising interest rates, which are not helping not rising interest rates, but rising bond yields, which are not helping the market right now. So we've been seeing the seesaw. All of a sudden, Nasdaq's up, 3%, while the Dow and S&P are basically down. All of a sudden, the next day, it's the complete reversal. So we're having this tug of war seesaw action in the markets. Haven't had a clear direction yet, but likely as we said, the end of March into April, we'll probably start to see a solidified direction for one of these two. Either way, thank you so much for tuning in to us. We appreciate it as always. We're here to support you. Your money is here to support you, and we'll see you again next week. Thank you.